So good morning, everyone, and welcome to our investment briefing webinar. So my name is Tracy. I'm a financial advisor here at O'Brien's. Given the recent market fluctuations, so we aim for this event to provide you with some insights into the reasons for market movements and the importance of focusing on the long term at times like this. So in the past, our clients have found these events to be valuable as an additional update outside of our regular one-on-one conversations. So we thank Morningstar for partnering with us in delivering this event for you. Today, we would like to introduce Stuart Mare as our guest presenter. Stuart is an investment specialist at Morningstar and is going to provide us with a review of the year so far and explain how to effectively also ride the storm to remain on track to achieving your goals. We will take questions at the end of the sessions, and if you have any questions, please use the question and answer box at the bottom of your screen. Following the event, if you have any further questions, please contact myself and the financial planning team at O'Brien's, and we'll assist you in regards to your personal needs. So Stuart, if you'd like to start.
Thanks, Tracy. Big thank you to O'Brien accountants and advisors, Tracy and Mark for the opportunity to present today to your clients. And unfortunately, the heading of today's presentation is Riders of the Storm. And not only is it the opportunity to include a Doors song in a presentation, it's certainly appropriate in terms of the waters we are navigating at the moment, and I think some of the discussion for today. So we certainly hope that coming out of today, you'll have a sense of why we are where we are at the moment in markets, what's brought us to this point, what we feel will be relevant going forward, and as such, how we are managing money for our clients and for you in this environment. Just want to make sure I've got the right sort of screen going before I get everything in the way. Okay, so slide one really talks to the cocktail of volatility that we have had to digest thus far in the year of 2022. And ultimately, the red line that sort of transpires through this chart is one of the MSCI World Index. So this is global equities since October of last year, and ultimately you can see that the journey hasn't been a particularly good one, and the headlines have not helped. So whether it's been a Ukraine conflict with Russia that's escalated into war, whether it's been a supply chain bottleneck as a result of COVID, and particularly further COVID restriction in China. And ultimately, I think taking center stage at the moment is certainly the rate rising cycle that is well into its stride, as well as inflation numbers that continue to come through very much above expectation and certainly above anything we've experienced for the last 2 decades. So all of this has translated into a lot of volatility year to date, and certainly more volatility than we have become accustomed to over the last decade. That is certainly captured in in the next slide, which is one of a lot of red. And again, it's not going to be all sort of doom and gloom today, but year to date, we certainly have had a lot to deal with in terms of capital markets and what they've given us thus far. Just to give you sort of to unpack the slide a bit, at the top we've got the return from equity markets across several different countries and emerging markets, and really the point to make here is the US has led the way down, and that's a significant number. Whereas previously the US was the market that was certainly providing a lot of bullish sentiment into the market and seemed bulletproof. The UK recently has joined its peers in the red. This slide updated to last month, the UK was still positive in base currency, but ultimately equity markets have sold off quite meaningfully year to date, and we'll unpack why. Within equities, an important point of distinction has been the difference in returns from a style of investment in growth versus value. And the reason I highlight that is because we'll unpack this as an investment theme as we work through this presentation. But growth is an investment strategy or an investment sort of sector of the market that has really enjoyed a lot of the conditions up to the end of last year that markets have afforded, which we'll unpack, including low interest rates and a lot of fiscal stimulus and monetary stimulus as global central banks have been very sort of soft with their approach, while value through that period lagged. As interest rates have started to increase and inflation has come through, we've seen that sort of rotation where growth historically had outperformed. When I say historically, over the last decade plus, had outperformed value. Value has certainly been a better place to be year to date versus growth. And value, when we talk about value, we're talking about companies that are trading at a discount to their intrinsic value, or companies with a low price to earnings multiple ultimately, or a low dividend yield. So those sort of unloved positions that were probably neglected a bit by the markets in more recent times. This bottom part of this slide is important to unpack as well, because these are your defensive indexes. These are bond indexes in various shapes and forms. And ultimately what we're showing here is traditionally the more defensive asset class, which has been bonds, has not come to sort of the table this year, and has also sold off aggressively. So you've had this perfect storm in effect, going the other way in terms of the experience we've had thus far in 2022, where both growth assets and defensive assets have really suffered quite a bit of pain, and we'll talk to why as we go through this presentation. So just that's the landscape we're in at the moment. Within that context, we just want to have spend a few sort of slides on some of the themes that have got us to where we are today, and potentially dominated headlines and your discussion with O'Brien and your advisors. Ultimately, this tells most of the story, and what this chart talks to is 10-year government bond yields across some of the developed markets, and indeed in Australia. Now, I know that sounds a bit technical, but ultimately all this is showing is the rate at which governments were issuing debt, and the yield on that debt has come down consistently, even over the last 2 decades, ultimately to, in a case like Germany, negative territory, which is basically where you are paying Germany to borrow money, as opposed to the other way around. And when you get to these sort of extremes, there's no way of coming out of this sort of position without taking some medicine. And ultimately, you can argue that this is a problem that's been pushed out by central banks since the global financial crisis, as yields have come down. And at the end of last year, we saw the bond markets starting to anticipate inflation, and therefore yields starting to tick up in anticipation of rates going up, because markets are forward-looking mechanisms, and as such, in anticipation of that, yields started to pick up. That medicine I mentioned, the market having to take, started to translate, and this is indicative of the risk-off trade that we've endured since the end of last year, as rates have started to increase, and yields have reflected that. And this, when yields go up like this, that's when bond markets, the capital value of bonds goes down. It's an inverse relationship, and as such, that talks to some of the red I mentioned in the previous slide, where defensive assets are concerned. This, interestingly enough, these yields ticked up quite meaningfully recently on the back of a higher inflation number out of the US, and you'll see that I'll talk a bit to that in terms of what the market expects going into the end of the year in terms of interest rates.
Stuart, we just have one question. If
Yes.
you're happy to take questions as we go.
Please.
Just relating, I think, back to your prior slide, is what is the contribution of tech stocks to MSCI USA, and which sectors are contributing most to volatility? Yes,
I've actually got a slide that pulls that out and shows you sort of what's happened in that sector. It by virtue of its growth, it's a big part of the pie. I don't have the exact number. It's come off a lot though. So if I had to hazard a guess, it's probably around of the MSCI index, it's probably around 20 odd %, if not more. For something like the Nasdaq, it's a massive percentage of that index, because that's a tech heavy index. So MSCI is a bit more diverse, but it has been a bigger part of the pie given its performance. I'll talk to how aggressively that's sold off and what it's done to the S&P 500 as a more direct index in a couple of slides.
Great, thank you.
Yeah. The other sort of part of the puzzle that you could argue is not fully discounted at the moment is how much debt global central banks have taken on to the balance sheets, and this is a slide which talks to the growth of that debt since 2008, so since the global financial crisis, for banks like the Fed in the US, the European Central Bank, and the Bank of Japan. And I think it's just important to understand the magnitude of that number, or these numbers, which are trillions of dollars, euros, and yen. And this certainly stopped. We haven't seen this increase, this number, but the stimulus itself has stopped, and markets are pricing that in addition to rising interest rates and rising inflation. So this perfect storm leading up to the end of last year, I've mentioned the perfect storm going the other way year to date, certainly for the last decade plus, on the back of the previous slides, historically low yields, as well as your going the wrong way, yeah, as well as the cash that we've sure, my mouse is very sensitive. I'll switch to keyboard. As well as the cash and stimulus that has been pumped into the market. It's been an unprecedented ride for growth assets in particular that really do well in an environment like that. So the first theme we'd like to call out today is one of the disconnect between value and growth. So I mentioned those two investment styles early on in the presentation. What this slide talks to, and this is a slide that we identified in the middle of last year already. So it is only updated to September last year, and that's by design. I'll show you the updated version in a few slides to the end of April. But ultimately, towards the middle of last year, we started to see this strong disconnect between value and growth. So the top green line here is the MSCI World Growth Index, and its 3-year excess return relative to the MSCI. So again, these acronyms are terrible, but MSCI is the Morgan Stanley Composite Index, and all it is an indicator of what equities are doing. So the top line is growth equities and how much they've outperformed the standard index, which is a mix of all equities. And the bottom line is the blue. The bottom line, the blue line is your value index and how that has lagged. So ultimately, what we're showing here is, these two, if you take the relationship back to 1979, tend to revert over time and cross one another. And this was a relationship we identified as being pretty extreme in the middle of last year. So we started to buy into the blue line and opportunities there when we saw this disconnect developing. This second slide is one which talks to how consistently a traditional balanced portfolio has outperformed, or sorry, growth portfolio has outperformed over the last decade. And what we did here was we built a portfolio with 35% in international shares, 35% in Australian shares, 12% in either of domestic and international bonds, and 6% in Australian cash. So very vanilla. What I mean by vanilla is very basic, very stock standard. We didn't do anything with this portfolio. We just back tested these allocations over the last decade. And what you can see here is that over the last decade, that portfolio delivered a return in excess of inflation plus 3.5%. So CPI is your consumer price index, that's inflation. And it outperformed that hurdle 96% of the time on a rolling 3-year basis. So the point is, in a market where a rising tide lifts all boats, the experience for investors was typically a good one, because you could almost invest in anything, and 96% of the time you got a real return on your investment. We would argue that that decade of easy gains is potentially behind us, and I'll unpack what we feel needs to be the strategy going forward. So those were the big themes that we feel dominated discussion heading into this year, and certainly even early on this year. What are the themes, and sort of expanding on those themes looking ahead? What do we need to consider? So this is that same value versus growth slide that I went through earlier, theme 1. And what we would point out in this slide is that even though value as an investment style has made a strong comeback year to date, and this is that same slide, that 3-year excess return updated to the end of April, there's still a lot of ground to be made up between the two if this reversion continues. And as such, all we're saying here is you need to be aware of this in terms of positioning, and the fact that we could still be in for a bit of a recovery from value as an investment style in this environment of rising interest rates and high inflation. Certainly, if you look at the graph, it looks like there's still daylight and still room to go. The second theme, and this is quite a busy slide and quite a technical one, so I'll spend a bit of time unpacking what we're talking to here. But ultimately, the green line at the top here again is an illustration of large growth companies in a all-country world index. So this is growth as an investment style again over the last 7 years, and the bottom line is value again. And you can see if we go back 7 years, your growth stocks and positions that in large, a lot of those tech stocks that one of the audience questioned earlier, they re-rated or their multiple grew from 21.3 times coming into proceedings in December 2014, all the way to 34.8 times towards the end of last year. And what do I mean by times? What do I mean by multiple? The measure that's used in this graph is one of price to earnings. Price is at the top, earnings is at the bottom, and that's a PE multiple that is one of the indicators markets keep an eye on. And what drove this relationship, what drove this chart up, was the P in the price to earnings. So your price or your price expansion went up, and therefore this green line went up. The E in that indicator, the earnings, did very little to push this up. And that's important because we feel that in this environment we're in at the moment, that E, that earnings, needs to be identified in terms of what's going to deliver for positions and therefore for investors in portfolios. The value line at the bottom here traded largely sideways over the same 7-year period, rising from 14 times to 15 times. So again, going forward, it's the E in that price to earnings multiple that needs to be really sort of given due regard and consideration in an environment that's not going to just be as easy as we've enjoyed. And on the back of that, I'll come to the tech slide. I thought this was a a good slide to illustrate that the previous principle in action. This is really, these are the FANG stocks. So this is, historically FANG was the acronym used to describe Facebook, Amazon, Apple, Netflix, and Google. Subsequent to that, Facebook is now Meta and Google is now Alphabet. So the acronym will probably, no longer exist, but it has been a good one to sort of couple those. And you can see the blue line here is the performance of those stocks on their own, stripped out of the S&P 500 tech index. And really, their performance drove this index up. This is the green line is the S&P 500 tech index. The blue line is the FANG performance stripped out of that. And that index peaked, or the FANG performance peaked in November 19 of last year, which is when the market started to look forward and anticipate inflation and rates starting to rise. And subsequently, that's fallen off a cliff in a big way down to its current position, even below the S&P 500 tech index at the moment. So, certainly tech stocks and growth stocks have sold off aggressively as interest rates have started to increase, and as the market prices in more meaningful interest rates into the end of this year. Quickly, why is that the case? That is because growth stocks and growth positions, their current value is discounted as a discount of their future earnings back to the present. Okay, so if you consider what that discount rate is, it's the interest rate, the prevailing interest rate in markets. So as that interest rate goes up, so the discount rates of future earnings goes up, and the present value of those positions is if it's priced for perfection, it will sell off against a higher interest rate. Hence these positions coming off so meaningfully. So that was theme 2. Theme 3 is one of inflation and recession risk. And I think for anyone reading the papers or keeping track online, this is probably what's dominating most of the headlines at the moment, and rightfully so. Inflation in the US at the moment is around 8.6%, and in the UK it's even higher, over 9%. So this has brought a lot of volatility, to the table, and certainly central banks are now acting to sort of counter this, this higher inflation in the system. The left-hand side of this slide talks to CPI, or Consumer Price Index, as a number in the US. That's 8.5%. Core inflation strips out some of the bigger influences in that number, and that's still at 6.5%. These are big numbers, and hence a lot of the pain that the market has priced in. I think more importantly, this chart to the right here, which is the market's expectation of interest rates and where they will end the year or enter 2023. This is updated to May, and it talks to an expected sort of rate cycle getting to just under 3% in January in the US. So this is the Fed funds future implied rates. This now updated to today talks to a number in January of 3.92%. So it's gone up, it's jumped up on the back of a higher inflation print in the US more recently. And if we consider where we are today in the US, that therefore means there's a lot to price in heading into the end of the year in terms of rate increases to expect. As a matter of interest, the same applies to Australia, where in Australia, a sort of future implied rate curve, there is anticipation of rates getting closer to, if not above 3%, coming into the new year. So the market certainly is pricing that in. Whether this is overdone or not remains to be seen, but certainly expect more rates increases as inflation continues to be sticky. That being said, and this is a leading in the sort of a future-looking indicator that we look at in sort of some of the work we do. And it basically talks to an inflation expectation 1 year out. That's the blue number here. So in the US, the market sees inflation coming off in about a year over the next year to around 5.4%. That is from that number of 8.5, 8.6% on the previous slide, and over 5 years down to 3.3%. Now, it's important to note that these numbers are still higher than what we've become accustomed to, but 3.3% is certainly something that's a bit more manageable than 8.5%. And as such, the sort of red part of the heading here is important to remember. This too shall pass. And bear in mind, because markets, again, are forward-looking, a lot of the bad is already priced into equity markets and certainly into bond markets, if you look at where yields are trading right now. Okay, so we've covered sort of the investment themes potentially that have dominated discussions leading up to this point, and those that will potentially lead discussions. Within those themes, what are we doing from an investment point of view? And some of the next few slides are important in terms of the basics. This is a quote by Mr. Warren Buffett himself, chairman of Berkshire Hathaway, and one of the highly regarded value investors of our time. And I'll take some time to read it because it's important to just talk to some of the simplicities in the slide. So, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is, and this is important, a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. So in any environments, and in all environments, but particularly I think when there's a lot of noise, it's that sound intellectual framework that needs to govern your decisions and that you need to stick to in terms of not letting your behavioral biases erode from the journey, your goals that you've discussed and agreed with your advisors, and how to get there. So in that sort of tone, we certainly stick to our knitting throughout cycles, and our knitting is our investment principles. Very basically, they are putting investors first, being independently minded, investing for the long term. I'm going to unpack being valuation driven and taking a fundamental approach, because those two I think are key in this environment. Minimizing costs where we can and building portfolios holistically, which again is really important in an environment like this. Stripping valuation driven and fundamental approach out of those investment principles. When we say we're valuation driven in our approach, what that means is we are very concerned about what we pay for a position. So price is what you pay, value is what you get. And where possible, if we can buy quality investments trading at a discount, that tends to deliver for investors over time. Taking a fundamental approach or fundamental analysis in our investment process talks to identifying those companies or businesses with strong barriers to entry, strong balance sheets, and strong cash flow. What we mean by strong cash flow is typically a metric that is called free cash flow, and that is profit left on the balance sheet after accounting for capital and operational expenses. And all that really talks to, in investment terms, is quality. If we can buy quality positions in a market like this, we're very happy to do so, because we feel that they will be able to absorb or pass on, some of the inflationary pressure better than smaller companies who're still building up that robust balance sheet capability. So again, tying into the themes we've identified, that value growth disconnect is a classic example of needing to identify opportunities in the market early and being positioned and having the conviction to buy into those opportunities when the price is right. And this slide talks to our approach in our growth strategy, where our 70-30 strategy, so 70 in capital growth assets, 30 in defensive, where we built up our value exposure to value early on in 2020 already, and as those positions started to pay off, so we took profits to the point of having a lower allocation currently. However, it is an environment where we're hugely active, and we're redeploying that capital across the portfolio into other opportunities as they arise. But you can't trade into that position, now necessarily, having identified the opportunity early on last year. That was really the time to be filling your socks. Theme 2, that sort of idea of active skill being needed in this environment. So we certainly feel that as a global company, we have a great degree of breadth under the hood, and the research capability to identify those opportunities beyond sort of the more traditional market. So at any point in time, we have access to, this is actually slightly conservative, we've probably got access to about 250 stock group ratings across countries, across investment factors and regions. We've also got about 150 bond group ratings across the same sort of measurables. And what that means is the starting point for us in terms of the ideas that we can look at and build into portfolios is probably ahead of the pack. And ultimately, that means that we can look under the hood beyond just the engine and find those opportunities for investors in a market like we're in at the moment, where potentially, the opportunities will be more difficult to identify. And the second part of this heading is importance. It's not just about capturing the opportunities, but it's about managing the potential for loss. Why is that so important? This is a slide we talk to quite a lot, and it's one of making sure that we regard the downside. So this is purely maths, and what it talks to is, if you invest into a position on day one and you lose 40% of that position, you have to make back 67% just to get back to the starting point. So if we can buy the based on that valuation driven approach, if we can buy positions that are already trading at a bit of a discount to their value, that naturally protects some of the downside and means that hopefully you end up in the blue more often than the red in terms of compounding on the upside and not the downside. And this is key for us in terms of the journey for investors and staying invested until you've achieved your goals. Again, this slide can be quite technical. What I'd like to highlight in this slide, and it's an extension of theme 2, is the quote by Mr. Howard Marks, which is, it's much easier to make money when the world is depressed, because when it stops being depressed, it's like a compressed spring that comes back. So in this environment, we find that there are those coiled or compressed spring opportunities that emerge. And I'll talk to 2 practical opportunities over the next 2 slides. All those opportunities are opportunities where in volatile markets, positions are sold off aggressively. And if we can identify those positions and correctly calculate their fair value, the shorter term upside from a position like that could be a lot more favorable, even though the valuation itself is a longer term one when we do our homework. So just to maybe give some sense of what that looks like in practice and to explain this chart a bit more meaningfully, I've got 2 examples. And the one example is energy. And this is an example that we certainly bought into with a lot of conviction. And this is that compressed coiled spring effect, this blue line here. So what happened was, in COVID, energy sold off aggressively, this blue line. The green line again is global equities. And we, at this point, started to see an opportunity where we felt that the market was overly aggressive in its sell-off or discount in energy. So we were building up a position in this period here where most of the market didn't want anything to do with energy. Then the COVID-19 vaccine was identified, and all of a sudden the world wasn't going to end, and energy started to come back. This is that coiled spring effect, which had another leg up more recently with the COVID, with the Russia-Ukraine war that transpired. We could not predict that catalyst, but what we could see and what we could hang our hats on was a position that was certainly discounted meaningfully and trading at a good price relative to the markets. Sorry, was that a question?
There is one question here, Stuart,
Yes.
that does relate around. We've observed some corporates increasing prices to the consumer in a way that does not at all reflect their costs, e.g. fuel. Arguably, they are price gouging and governments may step in, sovereign risk. How does this factor into assessments of value?
Yeah, absolutely. So that's got to, that probably comes sort of beyond value itself. I mean, value is quite a singular measure, and you've either got a position of value or you don't. That I think would even come through to a degree on sort of the ESG side in terms of governance and making sure that that's part of your investment process. Certainly, as you know, from a value, and not to skirt the question, I'll answer it. I'll finish my answer shortly, but as value has recovered in this sector, so we've taken off a lot of our positioning. So we came into the year with about 15% in energy in our growth portfolio. We're now at about 5%. We certainly, from a qualitative point of view, keep a close eye on principles like that. And if we do feel that there's poor governance and poor practice in that sector, we've got no problem selling out of a position if we feel that the price will reflect poor practice. Gas in particular has gone up incredibly, and I think you do get these sort of these instances coming out from corporates when they've had this sort of incredible run and the market is long energy. Again, we've now enjoyed most of our upside already. So if that is something that will lead to energy weakness, I think we've managed to bag the profits, and we're largely sort of reweighting our position anyway. So we're not too. Hopefully, this won't affect our investors, but it is part of our process. It's certainly more one that comes through on our risk analysis and risk mitigation, which is built into our investment process. Okay, so this is one of the ideas, the coiled compressed spring ideas, that has paid off for us and for investors, and hopefully for you if you're invested with us. A new idea that we are sort of starting to explore and building into portfolios is one of Chinese IT or China IT. That does come with a strong disclaimer, however, that we're very aware of regulatory and geopolitical risk in this sort of idea. So we're never going to adopt a huge position in it. However, from a valuation point of view, we're happy to adopt a smaller position given the disconnect that we see here. So this is China IT as an index versus the Nasdaq 100, which is also a tech heavy index. And this disconnect started sort of halfway through last year when the regulator started to get involved, and prices therefore built that in. We feel that at this level here, there's certainly opportunity for some of those companies to survive and do well. And as such, we think this could be a coiled spring opportunity in the making. Again, with the disclaimer that we're never going to go in boots and all, but it is a smaller position in portfolios that we think could pay off for investors. Similarly to energy back here at this point in the cycle. So I know there's been a lot to absorb, and we're coming to sort of the finish line. So if you can press through and stay with me. Theme 3 is again the inflation and recession risk that really is dominating a lot of sentiment at the moment. We've taken the opportunity in the current market and the volatility to just reweight our portfolio into quality in particular, and I'll define what we mean by quality. But just to sort of make sure that the robustness of our portfolio is in check, which typically it always is. But quality in an environment like this is one we prefer to be long or be more invested in than some of the other investment factors. So all we're talking to in this slide is the fact that this longer sort of chart, bar chart, is our current allocation to global quality. Whereas coming into the year, we had a lot less of quality in our portfolios. We've also increased our allocation to developed market bonds as we've seen those yields tick up to more attractive levels. And we feel that bonds also offer a bit of a safety net in a recessionary environment, which, the jury's still out on whether or not recession is on the way, but certainly the bond market thinks it is. So again, further to my promise in the previous slide, what is quality in our view? And I've touched on this before in terms of that, that cash flow and the strong balance sheet. But quality for us represents companies with less earnings variability and that cash flow generation I mentioned earlier. Companies with less debt on the balance sheet, and companies with a sustainable sort of moat or competitive advantage and pricing power to deliver on return on capital for investors. So how that's translated in terms of an actual investment in portfolios is we have increased our allocation to the Morningstar International Shares Unhedged Fund more recently. This is a zero-rated, zero-fee fund in our solutions, but it is one that certainly demonstrates the credentials of quality that I mentioned previously. The blue chart here is the fund itself, compared to global equity in green. The purple block is that China RT proxy that I mentioned, or index, and orange is a global equity value. So across all those different ideas in our portfolio, quality certainly exhibits the best characteristics in terms of its free cash flow or its excess cash on the balance sheet, and similarly, in terms of its financial leverage or debt on the balance sheet, it's a lot lower than the rest. So these are your sort of global franchise companies, the likes of GlaxoSmithKline, Apple, what's another one? Richemont. These are companies that we like in environments like this in terms of their robustness. And why is robust portfolio management so important? It really comes through in a strong market. So you probably could have got away without a lot of it coming into this year, but certainly it certainly separates the men from the boys in down markets, and it's something according to our own Chief Investment Officer Dan Kemp, we take very seriously. And the proof needs to be in the eating, I guess. So I'm not going to spend too much time on this slide, other than to say the riders of the storm heading is one that is playing out in the current market. And this red line here is the growth portfolio in our world, which, relative to some of its peers, has delivered for investors in terms of its mandate. Albeit, it is a tough year-to-date reality for everyone in terms of that absolute number. But we're very. It's good to see the portfolio doing its job in terms of that being mindful of the downside and also riding the storm a bit better than other peers in the market and the market itself. And this is just over 1 year, by the way, in terms of the storm that has been. So just to really sort of bed down those investment principles, flexible and robust portfolio management is crucial in this environment. The price you pay for an investment is really important. And certainly if we can get quality investments at a discount, that's our ideal environment. In times of uncertainty, there is irrational behavior and investment execution. So we look for those opportunities to buy into and certainly to deliver longer term outperformance or alpha for our clients. Said another way, the opportunity to buy attractively priced assets typically comes when no one else wants them. What does flexible and robust portfolio management look like? Ultimately, in this environment, we're building portfolios that are not reliant on a single scenario or outcome. There are a lot of unknowns out there. Macro forecasting is probably not something anyone can do with a great degree of consistency. But if you can build your portfolio with enough levers and enough differentiators in terms of the drivers of return, that typically means that you come out on top in a market with a lot of volatility. And as I mentioned, the lower potential for permanent loss of capital is always top of mind for us. So key takeaways for us in this environment: volatility is nothing new. We did go through a period of historically low volatility in markets. But if you've got the research capability and if you can correctly identify the worth or the value of an investment and buy it for the right price, we think you'll do okay in a market with volatility. We think the ability to go beyond broad markets and invest with conviction is certainly important in this environment. As I mentioned previously, building portfolios that are sort of prepared for multiple scenarios is key, and buying into those opportunities early so that you can enjoy that coiled spring opportunity or unlock when it comes through is also something we hang our hats on, and does require sort of a disciplined approach, looking through the cycle and through the noise that is currently in the markets. That is my presentation. Suffice to say, do you need to add the health warning that anything that we say in an update like this is certainly not advice and is general in nature. For the real advice, please talk to your advisors at Brian. Thank you. I don't know if there were any other questions.
Thanks, Stuart. There was just there was one comment. By the way, the Doors song is Riders on the Storm. So
of course,
thank you for pointing that out. We'll have to make an adjustment there to the title.
Yes.
So thank you for that. The other question was curious what stocks are in the China tech sector. Are there any we would know of?
Yes, so they are. Bear in mind, we need to access those investment ideas with what's available to us, depending on how you invest. What I mean by that is whether you're investing in a fund or a separately managed account. But typically, Alibaba is one such name. Tencent would be in there as well, because we're investing through an ETF. So we've got typically we've either got a China ETF or a China IT ETF, which would then hold a grouping of those tech names, but ones that I'm sure the audience would know are the likes of Alibaba and Tencent.
Wonderful. And another one that's just popped up here: does Morningstar participate in Bitcoin, and do you agree it's a Ponzi scheme?
Okay, we certainly don't hold any Bitcoin in our portfolios. It's an interesting investment discussion, and I think ultimately anything without a cash flow for us is very tough to value, and as such, we would never buy into a position like that if we can't attach a discount to a cash flow and get a present value. So I do think a lot of it is driven by a generation that looks for the next best thing, and there are some early adopters in crypto that are retirement stories in themselves, but certainly we would not be too far from agreeing that there are Ponzi credentials to it. And I think anything that professes to be easy money quickly, you've got to be careful of, because typically the easy money's been made. and you could be buying in at the wrong side of it. So not something we have in any portfolios or profess to have any investment into anytime soon.
Wonderful. I think that's that wraps up all the questions. So thank you, Stuart. Tracy, did you want us to wrap up anything before we close out?
No, ultimately you've covered off some of the questions that we already had. So thanks again, Stuart, and also Morningstar for partnering with us as well for delivering this event to you. If you have any questions, please feel free to contact myself or the financial planning team at O'Brien's, and we'll assist you in regards to your personal needs.
Wonderful. Thank you all and have a great day.
Thank you, Tracy. Thank you, everyone. And yeah, have a great day.
Thank you.
Bye.
Cheers, bye.